All right, hey everybody, this is John, and I just want to talk a little bit about how do you know, like when I say a market is going down, that it's going to like go down all day long, like those days where the S&P is down like 100 points or the Nasdaq's down like 4 or 500 points, or vice versa. If the market's going up, and it's just one of those where it just keeps going up and up and up, and it never pauses. I.e., there's no fake outs, it doesn't come back at all. And just how do you tell? Because it's obviously super easy to see in hindsight how that works. So some examples recently, you had this day here where it was a pretty solid down couple of days. You had a pretty solid couple of down couple of days there. And if you kind of go through, and you'll see that most of the time, the market's pretty quiet. I mean, respective, right? It's just, from here to here. I mean, the S&Ps were trading between 6,300 and 6,400 for a long time, and it wasn't like there was any huge up days. There wasn't any huge down days, and by huge up days or down days, I mean about basically a 2% move. So if the SP, give or take, I mean 1.7 is still big. So if the S&Ps are 5,000, 2% move is 100. If the S&Ps are 6,000, 2% move is 120. And the thing about this is that it doesn't happen very much, right? These kind of days maybe happen most of the time on average, maybe a couple times a quarter. And what will happen on those days is either one, you can recognize it right away and you can take advantage of it, because if you can do that, that can make your entire quarter. Sometimes it can make entire year. That's the kind of day where, normally you might be happy with a 3-point profit on Meta. That's the day it goes up 30, okay? Or, you caught 12 points on the S&Ps, and that's the day it goes up another 80 or down another 80. And the thing about these days is that it's hard when it's happening. It's kind of surreal. It's like, oh my God, the market's up so much. But we've all seen instances where the market's up, and then it just fades and dies, and it gaps up and then turns negative on the day. Or there's days where it gaps down, and it's like, okay, this thing's going to rip and go positive, and it just keeps going lower and lower and lower. Now, if you're not in tune with this when it happens, like if it gaps down and you're buying the dip and adding to it, and it's one of those few days where it's just going to walk down, you're just going to get annihilated. And on the other hand, if you recognized it and went with it, it could have been one of your best trading days of the quarter. And so what happens in a situation like that is typically institutions are adjusting their risk profile, and they're either going full risk on, meaning like they're not trying to be cute, they just need more positions, more exposure, or it's risk off, where they're just, it's not like this violent selling, it's just steady selling pressure. Think of institutions just having their foot on a gas pedal, and there's just no relief to what's going on. So if we go back and look at this year, because obviously it's been a pretty volatile year with the trade disputes and stuff like that. So what stood out to me, so in January, January is pretty volatile. You had this day, well, this was December, but you had this day on December 18th, pretty big walk down day. And then you had this. This was a super interesting day here where we popped up. One of probably the starkest examples of this was in April, where you had these huge down days followed by these huge up days. And if you're just looking at a chart, it's like, well, the squeeze or these oscillators, they don't necessarily tell you very much. And then even if you look at, say, like a 5-minute chart, it's not necessarily going to tell you a lot, because there's no indicator designed to essentially explain what's happening to this. Because if you get something like this, RSI, oh my God, it's overbought all day. Okay, how does that really help? MACD, oh, it's staying stretched all day long. That doesn't really help, right? And what we need is information that says that, by the way, this move that's happening right here has an incredibly high chance of just continuing like this all day long, or to the downside, et cetera, whatever it is. And so what are the tools that we can look at in that kind of a situation? So what I've found in these kind of situations is that basically things like the VIX and stuff are great, when things get, really crazy. But if we go back to like that example, in April, it's like, okay, well, the VIX up, the VIX is all over the place, and it says, okay, it's a pretty volatile environment, but it doesn't necessarily say exactly like, don't worry, today is going to be a great day to the upside, or today's going to be a great day to the downside, et cetera, et cetera. So that's one tool to use. And then ultimately, I find that the tool that gives the most real-time analysis of the market is the tick. But the tick kind of by itself, it's a little bit, it's just a lot of, it can be, it's just a lot of back and forth. It looks like an EKG monitor. And so over the course of my career, I mean, I've spent 12 to 15,000 hours or more watching the tick. Okay, I've been doing this a long time. It's always in the corner of my screen. If I'm day trading, I'm watching it more closely than if I'm swing trading. But it's always there. And so there's things over time that I've noticed that are tells to look at to kind of let you know what's going on here. All right, so let's look at this. I just screenshots sometimes are easier to look at this. So this is that time in April. So if you see like, all right, here the market gapped up and then all of a sudden just kind of rolled over and died. And from this point to this point, that was like 350 points on the S&Ps. 49.10 is here, 52.67 here. And then this day, you can see we're kind of plodding along. And then suddenly, something comes out, tariff wars and all that. And when you see something like this, it's always hard to tell, like, okay, is this going to pop up and then just die? Or is this going to go and just keep on going until the close? And that's really the key piece of information that we want to find here. Now, there's tools that I like, the squeeze. I'm a huge fan of the squeeze, if you're familiar with that. I love the RAF Pro, but they're not designed to help with this kind of a day. They are designed for normal ebbs and flows. They're superior for normal ebbs and flows and helping to kind of create actionable entry and exit points, but they're not equipped for this, and a lot of things aren't, frankly. I'm a huge fan. These are quant pivots. They essentially, 90% of the time, the range of the trading day is within these quant pivots. On a day like this, it blows right through them. On a day like this, it blows right through them. They're not designed for these kind of days. If you're familiar with voodoo lines, same thing. It's like the market's moving like they aren't even there. They're not designed for this kind of thing. One thing that's close is this momentum tool. This is one I've talked about before. But what happens on a walk down day, while we're getting the yellow here, which indicates very firm downward momentum that you don't want to fight, it gives these false signal reversal arrows. Okay, and here's some false ones as well. So it's a challenge that way, right? So what do we got to look at here? So what I did is I took the ticks, and then I've studied them over the years and just really essentially boiled the ticks down to 2 layers. And that's what's mapped here. So if you get a combination of these 2 things that light up, so you get the upper echelon lighting up, and then you get this turning purple, those 2 light up together, generally at that point, you're fine, and you're looking for a market that has staying power, okay? Now, what you want to look for, typically on something like this, you'll keep on going, but of course, this was in the days of the tariff news and stuff like that. So if on the other hand, you see it drop and you get the opposite impact, you get 2 light ups here, so in this case, it's a walk up market until proven otherwise, basically by an opposing signal. Now it's in walk down market mode. And when this happens, you can see we just walk down all day long, and you can see it stays consistently lighting up both signals the whole time. So when you see both of these lit up like that, basically you stay short, okay, or you roll your deltas, or you just basically, when you see like a little up move like this, you don't panic because it's going nowhere but down. Now the next day, you can see here we're coming along, we get this move here, and you can see it's just kind of muted, right? We're kind of, it's kind of down, but then we're kind of up, it's kind of down. But then we get this move here, and it's like, gosh, is this going to last? And then you can see when you get the 2, starting here and here, when you get that, you're not going to catch it right away, but that's just telling you this thing has staying power. And that's, it's still 150 points on the S&Ps here. It wasn't like, oh yeah, I caught the last 2 points. 150 points is great. So anyway, that's the thing I like. I'm going to do a webinar about this, and there should be a link somewhere. You can click on the link, and it's a free 1-hour kind of a webinar on how this works and why and all that kind of fun stuff. And anyway, thought you guys and gals might like it.
Hey, John here with Simpler Trading. Thanks for watching. If you enjoyed this video, comment down below and let us know what topic you want to see us cover next. Also, be sure to subscribe and click the bell icon so you can get notified when we release new videos. And if you want to watch us trade in real time using our own money, go to simplertrading.com and learn how to sign up. Good trading, and we'll see you next time.